morning, good afternoon, good evening, everyone. Welcome. Thank you so much for joining. So a huge thank you to everyone for joining us today for our latest event in our Regulator Knowledge Exchange series. I'm delighted you to welcome today to today's event entitled Designing Open Finance as Digital Public Infrastructure, Lessons from India and Brazil. The event is being hosted in collaboration with the Centre for Digital Public Infrastructure and for the Bank for International Settlements. Before we get started, a little bit about me. My name's Nick Clark. I'm the head of the Regulatory Innovation Hub here at Cambridge Centre for Alternative Finance. We lead research, digital tool development and capacity building programs with financial authorities on the regulation of fintech and digital financial services. Prior to joining the centre, I worked at the Financial Conduct Authority in London for over a decade, laterally managing the FCA's regulatory sandbox. My interest is in the regulatory approaches to innovation and emerging technologies, which is why I'm very much looking forward to today's discussion. Our panel session today is part of our Regulator Knowledge Exchange event programme. As a peer-led and community-driven digital platform, the RKE is now providing a place where central bankers, financial regulators, supervisors, and policymakers can meaningfully connect, learn from their peers, co-create solutions, and collaborate by harnessing the power of community. On this note, on behalf of CCF, may I extend a special welcome to the RKE members who are joining us today. So to today's session, over the next 75 minutes, we'll hear from world-leading experts sharing practical insights and lessons learned from India and Brazil on the design and implementation of open finance. We're so grateful to have such distinguished guest speakers with us today. Now, just to set the scene a little bit, CCF works with regulators and financial authorities from all over the world. Some of the countries we speak to are well advanced in their open banking implementation journey and already have in place infrastructure which allows providers to access transaction data from banks. Other jurisdictions are just beginning this journey, taking their first steps towards conceptualization and design of open banking frameworks which will work for them. And of course, there are many places which are somewhere in between these 2 points. While open banking covers both payments and data sharing, open finance extends data sharing to other non-banking actors in the financial ecosystem, such as insurance, securities, and pensions, providing access to consumers' entire financial footprint. Open finance is an exciting and ambitious area, and many financial authorities are considering their role in its development. It is clear, however, that open finance, as a broader data sharing initiative, will require coordination and consistency across stakeholders and sectors. Digital public infrastructure is the rail upon which private and public sector actors can innovate and build new applications and products that benefit consumers, including those who are currently underserved. Open banking and open finance rails are examples of this DPI approach, and this is why I'm incredibly excited about today's session. By sharing the successful approaches to open finance among our regulatory community here today, we can learn the lessons of others, consider these insights in our own open finance implementation journeys. And on that note, I would like to welcome you, our audience, and hand over to CCF Fellow and my wonderful colleague, Bill Roberts, who will introduce our esteemed panel members and lead us through today's discussion. Bill, over to you.
Thank you, Nick. Well, as Nick said, we have 4 distinguished speakers who've kindly agreed to share with us learnings on various aspects of open finance from their different organizational and national perspectives. They are Kamya Chandra, Chief Strategy Officer at CDPI, the Centre for Digital Public Infrastructure, Dr. Rajeshwar Rao, Deputy Governor of the Reserve Bank of India, Otávio Damaso, Deputy Governor of the Central Bank of Brazil, and Yi Huang, Special Advisor to the Chief Representative for the Bank of International Settlements. After we've heard from all 4 of them, I will moderate a Q&A session. So could I ask you to post your questions to our speakers in the chat, and I will field them to the speaker you specify after all have spoken, so we don't interrupt any of the speakers. Just to say apologies in advance if we don't get around to your particular question in the time allotted today. We have a very, very large audience of regulators participating in today's session, so my apologies in advance if we don't answer all the questions today. Right, so our first speaker is Kamya Chandra. Kamya, I hand the virtual mic over to you.
Thank you. If you'll allow me to share my screen, you can stop sharing. Perfect. Thank you, everyone, for joining us today. Just to give you a bit of context, my name is Kamya Chandra. I'm the Chief Strategy Officer at the Global Center for Digital Public Infrastructure, which provides pro bono technology architecture advice to countries that are building open banking and open finance, among other digital public infrastructure. And we work with over 30 countries in this area. Quite happy to be here today. Let's dive in straight. I think we strongly believe that financial inclusion at scale can be achieved in a country's lifetime. It may sound like an ambitious statement, but in just a few years, with a few targeted actions, we believe that it's truly possible to uplift millions into the formal financial ecosystem. And we believe this happens in 3 phases. First, we think it's important to enable people to access the formal financial system, those who don't even have accounts. And that first formal account is typically done through the digital public infrastructure of a low-cost electronic KYC. If you are from a country where formal financial accounts are ubiquitous, nearly every adult is banked, then this may not be a concern for you. If you're from an emerging economy where you maybe have some challenges with an unbanked population, this is an important precursor to first bring in people into accounts that can be used to transact with payments and data sharing. Then you get into the second phase of what we call engagement, which is the payments layer, which allows for people to actually use those newly created accounts to actually transact in their everyday lives. The important thing in building this kind of infrastructure is to make sure that it works for low value and high volumes of payments. So that means a street vendor, on a road that is selling their merchandise for an extremely low value should be able to accessibly access digital payments. And that happens when digital payments is inclusive, it's interoperable and instant. Usually we focus only on the instant through real-time payments. And that's where open banking or open finance for payments comes in. As an approach beyond other approaches to digital payments. Finally, the third phase is to empower people with actually access to the financial services that will allow them to uplift their lives, whether that's a loan, an insurance product, or an investment that gives them some level of returns or security in their old age through a pension. These financial products counterintuitively depend on data sharing. Without the ability to share information at low cost in a tamper-proof manner, through individual consent, you cannot systematically scale financial inclusion of products, because at the end of the day, an institution offering a financial product has a cost of doing so and has a revenue return. And unless we build the digital public infrastructure rails that we call financial data sharing, open finance, that element will never take off on the credit side. And we've seen this is the key reason why many emerging economies around the world are actually choosing to build open finance rails to drive access to credit and other financial products. We actually believe that financial inclusion via open finance is not just important for an economic growth or second order economic effects perspective, but actually for financial stability, which is core to any regulator. First, it actually allows you to strengthen AML supervision when you have fewer dark transactions or an informal economy. Terror financing and money laundering is easier to monitor when your transactions are actually being logged in financial statements. Second, it allows you to have more effective monetary policy permeation through your society if most of the credit that's being utilized by people is actually coming from formal institutions rather from informal institutions. But how? Once you decide that you really want open finance in your country, how do you build this in a manner that will actually drive scale and security in your ecosystem? We believe that it's a techno-legal approach that's really critical. What do we mean by this? It means a combination of a regulatory framework and the right technology standards and specifications, without which you can't scale. Let's take an example first of the regulatory framework. In the space of payments, clearly identifying and demarcating roles of all the actors is a critical next step to be able to allowing each of them to do what they do best, allowing regulators to regulate and innovators to innovate. Fintechs and new sort of smaller mobile wallets are coming into this space, flooding into the space. The question is, how can we prescribe their role in a way where they focus on user interface innovation and not so much on the movement of money, where there are higher risks. And so we see often that both Brazil and India have actually crafted a separate license. In Brazil, the PISP license, and in India, the TPAP, third-party application provider license in payments for fintech players that can actually just work on the user experience of money, because they can be close to users, they can onboard users without actually being involved in the movement of money. And then the wider roles of the payment rail operator are optional in countries. It can be done by the regulator, or it can be done by a secondary team within the regulator. When it comes to data sharing, there's a few licensed roles that should be made really clear. Financial information providers and users, what are their obligations, roles, and responsibilities to make sure that data sharing happens in a regulated manner? And second, an optional ecosystem operator, which is a self-regulatory organization that can work to sort of advocate for the technology standards, as well as hold and update the technology standards as needed. In some countries, this role is performed by the regulator. In other countries, you have separate entities that can do this, but thinking through clearly what are the roles in this instance allows you that flexibility. Finally, this role of a consent manager is one that exists in the India ecosystem and not in the Brazilian ecosystem as a separate role, but you can think through whether or not you'd like to introduce a role of an entity that takes consent for data flows without actually being involved in the data flow itself. On the technology specifications, these are really critical to introduce. Without the introduction of these specifications, it's like bringing a knife to a gunfight. You come in to try to control what banks and technology players are doing. If you simply write regulations without backing them up with technology specs, it becomes very difficult to enforce those regulations in practice. This means that in code, by building a payments protocol that's modern, QR specification that you put out on data sharing, having separate APIs for data flows and for data formats, which can then change by sector, as well as a consent specification, you can enforce the good practices that you put out in your regulation through code. Finally, I'll stop here with this slide. We've done a brief case study comparing UPI and PIX, as well as the data sharing infrastructures in both countries of account aggregator and open finance. Please feel free to take a look at the technical deep dive of the differences between these two. But I'll close here for now and hand over to our esteemed speakers. Thank you.
Thank you, Chandra. Thank you very much indeed. It was a comprehensive description given the very short time you had. And now, please, can I hand the virtual mic over to Dr. Rao, Deputy Governor of the Reserve Bank of India. You have the floor.
Thank you, Bill. I hope I'm audible to all of you.
Yes, yes.
Okay. As a regulator, we look to frame and implement policies to minimize risk to the regulated entities and also ensure financial stability. At the same time, we also need to be open to innovations which can expand the remit of financial services in terms of scale, reach, and inclusion. And for this, I think technology plays a pivotal role as an enabler, which will make financial services more personalized, inclusive, accessible, and efficient. And open finance is the possible way ahead for this. Open finance is an extension of the concept of open banking. It empowers the customers, who are the real data owners, by giving them control over the financial data which is found in silos, so far available with the individual data holders, and allow them to share it securely with authorized entities using third-party consent-based architecture, so as to receive personalized and efficient financial services. So open finance has the potential to transform the financial landscape through finance as a lifestyle model, seamlessly integrating financial services into people's daily lives, exactly when they need them, with products and services that best meet their needs and receive the personal financial services they deserve. The thrust towards open finance initiatives in India started with the development of the digital public infrastructure. Today, it seeks to leverage on the interface of the three pillars of this, which is the identity, the payment, and the lending infrastructures, which have been or are in the process of being rolled out. The identification of the customer begins with what we call the JAM Trinity, that is the Jan Dhan account or the basic savings bank deposit account, which provides access to the formal financial services to the previously unbanked population. The Aadhaar card provides the digital identity to the Indian residents based on their biometric and demographic data. And a basic digital connectivity is ensured through affordable smartphones and internet connectivity. Together, they have helped us in ushering a revolution for underserved by enabling them to be part of the formal financial services. The payment infrastructure or the United Payments Interface developed by our National Payments Council of India enables seamless digital payments that allow instant money transfer into multiple accounts using a mobile application or a QR code. This is now going to be complemented with the recently launched platform, which we have called as the Uniform Lending Interface, which is currently under trial on a pilot basis. This will enable frictionless disbursement of credit, bringing in efficiency into the lending ecosystem by reducing costs, ensuring speedy delivery, and being scalable. This bouquet of DPI, that is the JAM, the UPI, and the ULI, can be conceived of as the new trinity, which will revolutionize the formal financial landscape in India. The launch first took place of the UPI, which was followed by the account aggregator framework, which enables secure data sharing across financial institutions. The account aggregator framework has transformed data sharing by putting customers in control of their financial information. With explicit consent as a requirement, and by maintaining control over their data privacy, customers can now decide who can access their data, for what purpose, and for how long. This approach empowers the individuals to share their financial information which is spread across various financial institutions with other financial entities to receive personalized services. Unlike traditional models where financial institutions held data in isolated silos, the account aggregator framework ensures that the data is securely shared, and that too only for consented purpose. Another crucial regulatory feature of this framework is that while managing the consent of the customer and transferring data to the financial information user, the account aggregators do not store or access the data themselves. This design is intended at ensuring the misuse is minimized or sensitive financial information is not abused. And so there is a greater degree of data security and trust for the customer. This is also in line with the legal framework where we have the Digital Personal Data Protection Act, which has been passed by the Parliament, which recognizes the right of individuals to protect their data and also the need to process such data for lawful purposes. I think two key features of this framework, which I thought I would highlight. One is its cross-regulatory collaboration is involved in this process. The account aggregator framework not only has comprehensive coverage spanning about 19 different types of financial information, but it also integrates with entities regulated by the various sectoral regulators, that is the Reserve Bank, the SEBI, the Insurance Regulation Development Authority, and the Pension Fund Regulation Development Authority, as well as the government departments. Second is a principle-based approach to address the inclusion enables us to have this as an adaptive and flexible framework. So if you want to add in new systems into the new forms of asset types, they can be easily integrated into the account aggregator system. Recently, we included the Goods and Services Tax Network of India as a financial information provider, which now facilitates cash flow based lending to micro, small, and medium enterprises. Having said that, I think there are a few challenges which perhaps need to be addressed to unlock the potential of this ecosystem. Now, one, we need an interoperable and inclusive account aggregator system. Some entities are reluctant to integrate with all account aggregators, given perhaps constraints in terms of bandwidth or the resources which they have to spare. So that can actually impact the system's overall effectiveness and reach. So this reluctance poses a challenge, and perhaps a fully interoperable and inclusive account aggregators ecosystem will perhaps be needed to ensure that this constraint is overcome. Then second is a lack of public awareness to the degree which is desirable. So despite the framework's potential, the public awareness is still a bit low. Increasing the understanding about the concept of consent and trust among the consumers is critical for widespread adoption. To address these issues, actually, we in the Reserve Bank have taken the responsibility of building awareness about the account aggregator framework through public awareness campaigns. Having said that, I think some key issues which need to be addressed. One is honoring the trust of the customer. Trust once compromised is exceptionally challenging to restore. And that is an example which all of us in the financial sector know very well. There have been rising concerns recently about frequency with which certain entities access data. So that raises the question of whether the data is being used strictly for the consented purpose or for some other purpose. It is essential that the financial information is accessed and used solely for the purposes which are explicitly authorized by the customer. This is not just a matter of compliance, it's about honoring the trust of the customer. Adhering to fair usage principles is crucial for protecting customer privacy and maintaining trust, which are fundamental to the long-term success and effectiveness of this account aggregator framework. Let me just conclude by saying that this inclusive open finance infrastructure has tremendous second-order impacts on the economy in terms of formalization, in terms of financial stability, effectiveness of monetary policy, Kamya just mentioned, and also controlled innovation. While challenges remain, the increased participation in the account aggregator system, coupled with Reserve Bank's commitment to facilitate the new trinity, I think lays the foundation for a good future for the open finance in India. However, the success of this ambitious vision depends on several factors. First and foremost, it requires responsible engagement of the regulated entities, which will ensure that the framework operates with the integrity and transparency so that not only it meets but also exceeds its potential, which will drive a more inclusive, competitive, and innovative financial future in India. I will stop with that. Thank you very much. I'll hand it over back to Bill now.
Thank you, Dr. Rao, for that very frank way in which you address some of the issues that you're facing, particularly on the account aggregation front. And thanks too for the three-letter acronym JAM. I hadn't heard that before, but I will remember it. Okay, so next up we have Otávio Damaso, Deputy Governor of the Banco do Brasil. Otávio, the floor is yours.
Okay. Good morning, good afternoon, and good night for everyone that is attending this event. First, I want to thank the Cambridge Regulatory Innovation Hub for inviting me to be a part of this seminar. The innovation process we are witnessing now in Brazil is centering on efficiency. We are seeing massive investments in modern hardware and software aimed at enhancing efficiency, transforming banks' technological infrastructure to meet more modern and flexible standards, and developing products and services that are more attuned to what Brazilian consumers truly want and need. There is no doubt that the speed and intensity of this technological transformation in the Brazilian financial system are, in part, the result of the Central Bank of Brazil agenda deeply rooted in actions that promote innovation. Having said that, I would like to talk about 5 key points regarding this innovation process. First, the first aspect relates to the motivation behind the Central Bank's commitment to this innovation agenda. The answer is clear. Our greatest motivation is to foster competition within the Brazilian financial system. The second aspect I would like to emphasize is actually more of a realization. There is no point in resisting or trying to block the process of innovation, especially when it comes to disruptive innovation. We are seeing this resistance to not avail across various economic sectors that try to fight change. When innovation is bound to happen, or when there are inefficiencies or high costs that can be addressed, the innovation process will inevitably take its course. Given this realization, I would like to bring up the third aspect, the importance of regulation being open to innovation process. This means being receptive to input from all stakeholders, whether regulate or not. The fourth aspect to highlight is that incumbents have also embraced this innovation agenda. They have adapted and transformed their legacy system to take advantage of the wave of increased openness, innovation, and competition. Incumbents quickly realized that resisting innovation and the entry of new players would be pointless, especially in jurisdictions like Brazil, where the central bank has been very open to this process from early on. And the fifth and final aspect I will mention is that this process has been carried out with great responsibility, particularly concerning prudential and security aspects. The open finance ecosystem, which is now fully operational in Brazil, represents a transformative agenda. Officially launched in 2020, open financing was developed by the market itself, but always under the Central Bank of Brazil vigilant oversight. Currently, in relation to data sharing, there are more than 52 million total consents and more than 34 million consents given by unique individuals. Over the last weeks, the participating institutions have made more than 2 billion weekly API calls, which shows the size of open finance ecosystem and how much it is being used. It is also important to mention that concerning our data and services scope, as well as the number of participating institutions, ours is one of the largest open finance ecosystems in the world nowadays. The open finance ecosystem refers not just to increased competition, but also to opening up a vast ocean of opportunities for innovation, enhance efficiency, including internal process, customizing financial products and services to meet actual customer needs, and increasing consumer conveniences. In this context, it is important to note that today all types of regulated institutions are developing products and services based on open finance. Some incumbents, for example, have more than 65 projects underway in various areas, all leveraging the potential of open financing. Just to give more concrete example of the impact of open finance in Brazil, participating institutions are reporting some benefits that they and their clients have received since the implementation of the system. One incumbent bank mentioned that because of the data sharing through open finance, it was able to increase clients' credit limits on consumer direct credit in the amount of $1 billion and on credit card limit in the amount of $120 million. Another incumbent bank said that it is originate more than 200 million on credit via credit portability, with 61% effective gain in the process, also due to data sharing through open finance. I would like to highlight 3 key lessons learned from the implementation of open finance in Brazil. First, well-designed implementation plan. The first lesson is the need for a meticulous design implementation plan that address all relevant aspects and consider operational issues that might initially seem secondary. Once again, this underscores the importance of comprehensive planning. The second one is regulator engagement. The second lesson is the necessity of an active involvement from the regulator in building this ecosystem. In my view, without close regulatory oversight, Open Finance would not materialize. Beyond technical issues, there are always divergent opinions on the path to take, which require almost continuous guidance from the regulator to achieve the objectives at hand. And the third one is the lesson of resiliency. The regulators face constant questioning from all sides. On the one hand, there are critics who agree that Open Finance initiative entail high costs, a lack of clear purpose, and a diversion of time and resource for existing products and services. On the other hand, supporters or challengers on this initiative are calling for even broader actions and faster process. I have no doubt that Open Finance will transform the Brazilian financial system in the coming years, even if customers and general public may not directly connect this transformation to the creation of the Open Finance infrastructure. In fact, that is one of the challenges of the initiative, since it is an infrastructure rather than a specific product or service like Pix, our very successful fast payment system in Brazil. Most financial customers won't even realize the value it delivers. Thank you very much.
Thank you very much, Otávio, for that, again, very frank account of some of the challenges you faced too, but also for some of the astonishing statistics, the API volumes, for example, and the increase in lending, which one of your incumbent banks reported being able to do. And finally, I think probably one of the biggest lessons in terms of the involvement, control, and guidance of the regulator, which probably contributed to the astonishing speed with which Brazil implemented open banking. So thank you, and we'll have some questions.
Thank you,
questions coming in for you, thick and fast. So
thank you.
Finally, can I hand the mic to Zhang, Special Advisor to the Chief Representative of the Bank for International Settlements. Zhang, you have the virtual mic.
Thank you very much for inviting me to join this such wonderful, workshop, and allow me to share my screens. So my name is Zhang, a former academia, and just joined the BIS. So my talk will mainly try to echo what the Governor Rowe and the Governor Damas and Shanti just mentioned. So more like some footnotes, try to understand how digital innovation and happen to promote such a so-called financial inclusions. So slightly different in terms of presentation scale, style. I would like to give some benchmark. I will start with a bottom-up approach rather than top-down approach in terms of open banking practice in Brazil and India. So firstly, let's look at the benchmark. So most of traditional banks adopt this kind of a traditional business model, can now serve small business lendings and provide financial inclusion service. So if you look at the United States, you look at right-hand panels, which is coming as a famous paper by Jeremy Stein. So look at cross times, there was a permanent decline for US big bank, small bank lending to small business. So we benchmark the most advanced capital market, financial market in the world, United States. So permanent decline from US banking service to the small business. So why? Because in theory, in front of financial inclusion, we have some barrier. Number one, which open finance mainly provided information, data, sharings. Information, bank account, accessibilities. More importantly, due to information asymmetry, moral hazard of selection, we have counter enforcement with more crucial things for a developing economy, so-called financial literacy. So today, my talk will follow the current practice in China, or mainly as a benchmark to see what's new, what we can learn from Brazil and India, both from top-down and bottom-up approach. In China, as we know, in the past 10 years, a lot of digital open financing, provide financial inclusion through payment, QR code payment I just mentioned, also consumer financing, SME lending, more importantly, investment inclusive, such as wealth products, through robot advisor, through all kinds of digital device innovations. So today my talk will mainly look at the advanced, the development in China as a benchmark to look at what we can learn from India and Brazil. So by recent work by my BIS colleague, you can left-hand panel, one of the Chinese big tech company called All Financial provide the financial service to a small business. If you left-hand side, you look at by my bank, the finance arm of our group, they provide more than 120 billion renminbi to more than 30,000 SMEs. Overall, in the right-hand panel, if you look at China as a total, in totals, so more than 3,600 billion renminbi provide is kind of small business lending or to the those small business and provide financial inclusions. So bottom line, we want to show what's new here. To summarize, we want to say, look, the experience from China, from India, and from Brazil is coming from the payment system. We start from digital payment innovation, then go through this kind of open financing platforms, finally provide the financial inclusions. So if you look at the business models, so a lot of big tech, private companies, such as e-commerce, social media, they run electronic platforms, use the network that provide, okay, besides the financial service, or besides the e-commerce service, by products, they produce a lot of customer data. By past, accumulate, through payment systems, accumulate a large stock of customer data. Through the data, payment systems, that start to provide a lot of financial service, okay, so-called open financing ecosystems. So overall, based on our BIS recent work, we use 3 words to summarize the key business model. Through digital payment systems, we have data. Through data, we go through all the platforms, network, provide financial services, so-called activities, ecosystem, so-called DNA. That's the key business model for bottom-up approach in terms of digital finance, open banking, and provide financial service. So what's the performance? So based on my recent journal finance paper, I try to show some performance in terms of how financial innovation through payment system is going to provide, okay, financial service to small business. So number one, why small business are very important for the whole economy, and why they lack of financial service? Because number one, they don't have an alternative financing source. They have a low scale, opaque income source, no collateral, and sometimes no financial statements. Very hard to access credit through traditional financial institutions due to high credit risk. Secondly, most of them, small business coming from developing economy, sometimes, the credit market is very segmented. And finally, they live in rural, remote areas, in the mountains, in islands, the far away to financial service, so-called the lack of financial inclusions. So can digital innovation help? The answer is yes. Digital finance innovation provide financial service use coming from open banking, open finance benefits, so-called information advantage. Then they use big data, machine learning, algorithm for financial service. Secondly, through the platform, the network, okay, online network, the distribution channel is very cheap, okay? Sometimes they provide financial service to the borrower without physical collateral, and sometimes they don't have a credit reference, credit score. And finally, why financial innovation, digital finance might have a low credit risk? Because of platform externality, two-side market exclusions. So based on my research, recent published journal finance, we do find out the causalities from digital finance access and from growth. Literally after first month, you will see average sales for borrowers, small business borrower from digital finance platforms increase more than 3.5%. Average transaction growth for credit access is more than 3% after first month. If you look at a more comprehensive way in terms of academic, studies, you realize sales growth after credit access jump more than 30%. Okay, And more importantly, so the customer's capital, customer attention, customer rating also increase after you accept digital finance credit. Okay. Overall, what's new here? Through digital payment innovations, digital finance have a lot of new advantage compared to traditional banks. Number one, information advantage. If you look at the right-hand panels, you can see that we are not only observed from the lenders, the online SMEs, sales performance, service rating, personal characteristic, and more importantly, how to use credit. Okay, they not only have information advantage, platform distribution channels, more important, also money is data platforms, and a very strong enforcement advantage. Based on recent discussion with Professor Ben Armstrong, we try to compare what's new here compared to traditional banking service, traditional lending models based on collateral. Once the collateral, you go to a financial institution, borrows money. There's a trade-off between collateral values and information cost. However, if we have open bankings, open financing, digital innovation from payment systems, the cost of information almost come to zero. Acquire information, store information, verify information. Okay, so information replace physical collateral, which is new here in terms of digital finance lendings. Due to time constraint, let me just give my final remarks. So future finance coming from open finance, digital financing will be very inclusive, scalable, or sustainable, because they rely on digital innovations, to rely on more data, aggregate data, and behavior data, a ton of data. Then they use platform, distribution, customer DNA models, combine what we call data advantage, hard information through credit scores, software information from behavior data. They try to build up this ecosystem with the trust and reputations. And finally, we also need a global collaboration in terms of technology, infrastructures, and institutional infrastructures. And how traditional banks and financial institutions collaborate with digital finance. That's what comes to today's topic. I learned a lot from Governor Rowe and Governor Dama's experience. The presentation talk about the Indian experience and Brazilian experience. Open financing is the key. Based on recent work by Augustine and about fintech, and more importantly, how to provide incentive and how to reduce information costs will help us to provide better financial inclusions. And the platform not only have online, also online offline integration. Finally, today my footnotes and provide some experience both from top-down approach and bottom-up approach, and provide future in terms of digital finance data governance structures. Okay, and finally, let me thank you and looking forward to comments and bon weekend. Thank you.
And good morning, good afternoon, and good evening to the colleagues around the world. It is my great pleasure to say a few words as closing remarks for this very important and also and very timely conference. Let me, of course, first join my BIS colleagues in thanking both the Cambridge Center for Alternative Finance and the Center for Digital Public Infrastructure for co-hosting this event. And as you have heard from various speakers throughout the sessions, in the increasingly digital world, the issues of the open financing, particularly the data, are of paramount importance, both for individuals and for SMEs and also business. And against this backdrop, there is an increased awareness that the open finance ecosystem can benefit financial system participants and society in general, in terms of the creating an environment in which the competitive advantages of different players can be used to provide people with better financial services. So, of course, the BIS, we work with our member central banks and other stakeholders and including the RBI and the Central Bank of Brazil, which both governors have shared their experiences. We also try explore some of these new dimensions through our innovation activities. One of the project we are soon will launch, which is dealing with our cross-border open finance infrastructures. This is a joint project with many central banks, to my knowledge. RBI and Central Bank of Brazil also joined the project. I'm not, this is, since this is the closing remarks, I'm not going to get into the details to the project. Instead, let me have a little bit reflections on what I learned or what is my main takeaway out of today's discussions. So firstly, in my view, there have been significant barriers to financial inclusions in most economies, but particularly in emerging markets. They emanate from a societal attitude, legal framework, and higher transaction cost. As the technology progressed, particularly in the last decade and a half, carefully designed DPIs, including open finance architectures, have emerged, which provide a potential way forward for countries to leapfrog traditional stages of development in this area. That's one takeaway. Secondary, in terms of the financial development, as my BIS colleague mentioned today, a collateral gap, because the large percentage of the world populations, including the SME, small businesses, even if they do have bank accounts, but normally they cannot borrow funds because of the inadequate tangible collaterals. So that's a collateral gap. So data and activities collected by digital platforms in this regard, can help to overcome these difficulties by bridging the gap and creating information as a new capital. Thirdly, we have heard how open finance can support financial stability. So the stability is one of the important dimensions for central banks. An open and efficient financial system can foster robust competitions, encourage new entrants, and keep existing service providers nimble. So these are very good development or encouraging development that will promote continuous innovations within this financial industries and hopefully lower the cost for customers. Finally, I want to mention that while open finance offers us, quite a wide range of the benefits, it also potentially poses significant risk and concerns. I think both governors mentioned it, particularly around the privacies and data securities, and of course as we all discussed, the robust governance will remain essential. So that's pretty much the major takeaway I wanted to share at this moment. So, but before closing, let me take this opportunity to once again thank the CCAF and the CDPI for co-hosting this conference with us. And in particular, I would like to thank Nick Clark for giving such enlightening opening remarks, and Bill Robert for his excellent moderations of the panel discussions at the end, as well as, of course, Kamya Chandra for her thoughts on the global best practice in open finance technology architectures. And of course, my appreciations goes to all the speakers, Deputy Governors Rao and Deputy Governor Damaso for your insightful views and lesson sharing of the lessons learned from your own countries. And of course, last, my thanks go to all the participants for tonight's conference. With that, let me close the conference. I wish you a pleasant weekend. And thank you. See you next time.